Hey guys, welcome back to CandleLight. Montana here. We've got another technical analysis video for you. I'm going to be talking about different kinds of charts. I've been getting some questions about, hey Montana, which chart should I be using, and what kind of data should I be using, and essentially the ins and outs on platform information and stuff like that. And I've been asked a couple times on what I should be looking at, and so on and so forth. Having the right tools for a certain job is a pretty important thing. It's really difficult to trade off the Apple stock screener, however you want to look at that thing, because it's only got a line chart, for example. And I'm going to be covering line charts in just a second. But essentially, you got to have the right tools for the right job. You can trade obviously without being able to look at the ins and outs and the nuances that a candlestick can give you and stuff like that. But you're not really set up for success. It can be done. I don't recommend it, but I'm going to give you my best opinion on what you should be using and why, and the pros and cons to different charts. Now, there are three main charts that pretty much every platform, whether professional or amateur or retail investor, is given, right? You have candlestick charts, you have a line chart, and you have a bar chart. Now you can also have all these other different variations. I've seen a few, but those are a bit more custom to like to certain ones. The candlestick, line chart, and bar chart, those are pretty standard. I mean, most platforms that you use will have at least those three. I use TradeStation just because it's like the Ferrari of all platforms. It's got everything you need. There are other good ones, but I've been using TradeStation for 10 years, over 10 years, and I'm very happy with it. It's simple. Like I said, I think episode 2 or something like that. I am not a computer guy, so something that's simple, straightforward, but still has the power to do a lot of stuff. I love that concept. So I'm very much in love with TradeStation. And TradeStation it gives you all three. So let's go over the pros and cons of candlestick charts, bar charts, and line charts. All right, now as you can see with candlesticks, as I've said before, or as I've showed you a lot of times on the past episodes, as I've given you information or given you examples of certain things, candlesticks tell you a great deal of information, not only emotion and stuff like that, but they give you 4 points of information. Let's just go for an example. Let's go for this one. So you have the open, the close, the high, and the low. 4 bits of information can give you quite a bit of knowledge. And what's so fantastic about candlesticks is it actually can give you not only highs and lows, but it gives you a body. And because it has a body, it can give you structures like this: a drop, base, drop, base, drop. Those are pretty really good supply zones, and they're very easy to see. I tend to like my charts kind of scrunched so I can see these structures a lot better, or like this drop base rally, which was the origin of this pretty good rally right here. And it also gives you the extreme lows of said zones. For example, this demand zone, you really didn't need the whole thing, which would have gotten you in right here. Sorry guys, I got to put my cursor on. Which would have got you in right here. But if you go for the absolute low, that's something that you can only get with wicks. And because candlesticks give you 4 points of information, you can get the dead lows, or the most extreme points of an imbalance of demand, which is here when price enters it, you really get a good rally out of it. You can't get that with line charts. Now, this is something that you can see on, if you type in any kind of stock or anything on Google, you'll see something like this, which is very basic and very uninformative, let's say. Now, the reason I have these pivot highs and pivot lows, I tend to like them anyway. Like, I keep them on my charts anyway. They're just really good, I'd say, indicators of, swing high and swing low, and then you have a range and stuff like that. Now, a line chart only has 2 pieces of information, just 2. Now, that's a huge detriment when it comes to having as much knowledge and, as much information as possible, because information is knowledge. If you only have 2 bits of information, that's half the amount of power you're working with, or that's twice the amount of power you would otherwise have had. Anyway, it doesn't matter. Have had, I'll use both, if you were using, or if you're using candlesticks. And here's why. I put these zones out for a reason. These two demand zones are a wonderful example. Let's kind of scrunch this up, and now we can kind of see this. This demand zone that was created was fantastic. It's a wonderful area of imbalance of demand. And when price re-entered it, it rallied, giving you a really good, 4 or 5 to 1 trade. This is the exact same movement right here, this rally and then this fall. If you were just using these, or this line chart, a line chart only uses the open and the close. It can't use the high and the low because otherwise it would be a candlestick. It only uses 2 points of information. So the demand zone would have been here, but notice the pivot points, and I left them on. Price actually traveled all the way down here. If you didn't have the pivot points, let's just take this off. Hold on one second. All right, if you didn't have the pivot points, then this would be your demand zone. Price would have traded through your demand zone, stopped you out because you always trade with the stop loss, and we'll go over that in upcoming episodes, and then gone your way. The demand zone was actually down here where these wicks are, but because you don't have that information with the line chart, you're not set up for success. Another wonderful example is this demand zone here, right here. This swing low, and it made a higher high, so we're in an uptrend. So in an uptrend, you want to buy low and sell high. When price entered your demand zone, you get, reversal candles. We talked about that. We talked about chart patterns and candlestick patterns last episode, and you tend to get those in areas of overwhelming demand or overwhelming supply. If there's a lot of demand or supply in a certain area, price will move quickly away from those locations or those areas, and they will give you those candlestick charts or those chart patterns or those candlestick patterns in those areas regardless, just by a matter of course. And rally here, the origin of that rally was right here, and the exact same thing happened to you as in this demand zone down here. Price broke your demand zone because actually the swing low was right here. And let me put the pivot points on for you. This is actually where demand is. If I can actually get that thing to go, there we go. That's where it is. Price actually traded all the way down there. That's the low, but because line charts don't have the high and the low, you can't see where the extremes of prices, which is where an imbalance of supply and demand exists anyway. So line charts are really good just for looking on your phone, but they're not that great for actual trading. So I highly recommend, if you have something like this and only something like this, either be very aware or be very cautious of what decisions you want to make in trading, or don't trade at all and wait until you can get some kind of platform that gives you something more along the lines of ideally a candlestick charts, or at the very least a bar chart. Now, a bar chart is pretty much the same, or is almost identical to a candlestick chart. Let me maximize this for you. It's almost the same as a candlestick chart. It has 4 bits of information. It just doesn't have the body. Let's use this candle that we were using before, or that I showed you before. All right, so let's use this candle here. The open was here. It fell, rallied, and then came down to close above the open, giving you a body. This is that exact same candle right here. This candle, this one, is that exact same one. And you'll notice that the four pieces of information are here. That's the open, because price is going from left to right. So that little notch right there, let me put my cursor on for you, because I know some people have a hard time seeing if I can find it. There we go. That's the open right there. Price fell, rallied, fell, and then closed to open the next candle here. And that would be the body. This candle and that candle are exactly the same. So you have 4 points of information. The reason why I prefer candlesticks is in terms of aesthetics and just in terms of being able to spot things like a drop-based drop, or just really good structures, which is what you want to be looking for when it comes to training your eye to spot good zones. Let me take that out. Is structures like this drop base right here, drop base drop, not as easy to see as they are on a candlestick chart. So a bar chart does have some pretty good information. It does have the exact same information as a candlestick chart. Just in terms of aesthetics, I have found that it's a lot easier to see structures and to just essentially it's just easier on your eyes and easier to train your eyes to spot structures with the candlestick chart than it is with the bar chart. So those are the main tools that most platforms have at the very least are candlestick, line charts, and bar charts. You can add a whole bunch of indicators, moving averages, like the RSI, MACD, all that stuff, and we're going to be going over all those. But in terms of just reading actual price or just raw price, I have found in my experience that it's a heck of a lot easier to use candlestick just because they have so many pieces of information, and it's just easier on the eyes to see. I don't recommend you using a line chart. If you want to just monitor your trade on your phone or something like that, then yeah, go ahead. There's nothing wrong with that. But if you're going to be actually like actively trading on it, then be careful using a line chart to say the least, because there's only 2 points of information on a line chart, which is the open and the close. You don't get the highs and lows, which give you the wicks. And as we covered in last episode, you tend to get reversal candles which tend to have wicks because that's where volatility is. Volatility is in areas where there's an imbalance of more supply or more demand, which is where you want to be trading in the first place. If you can't see essentially volatility, which is movement, which is what creates wicks, then you're kind of at a disadvantage. So I hope this was helpful. If you have any questions, comments, or anything like that, or if you have any topics that you want me to talk about, leave them in the comments, guys. I love answering questions, so have at it. Just throw them at me, and I'll be reading every single one. All right. I'll see you guys on the next episode. Take it easy.